The market looks unstoppable right now, but the most dangerous crashes in history? They all started exactly like this. There's a pattern that shows up right before major market crashes, and if you know what to look for, you can actually see it forming in real time.
You look at the market right now and everything seems fantastic. The S&P 500 is crushing it, hitting all-time highs, crypto is surging, and on the surface it looks like the party's never going to stop. But if you're paying close attention, you might be getting this weird feeling in your gut. There are these cracks starting to show: geopolitical tensions, a wobbly Fed policy, shaky consumer confidence. It all creates the sense of unease. So the real question is, are we in the middle of an unstoppable surge, or are we kind of sleepwalking towards a major correction?
Right. Let's just dive straight into that. On one hand, the market is just shrugging off global conflicts like they're no big deal. But, seasoned investors, they know that the biggest losses always seem to happen when that fear of missing out, or FOMO, completely takes over right before the floor drops out. So today, we're going to dig into why this feeling of, haven't we seen this movie before, is so incredibly strong right now.
And this right here, this really shows you the tug of war that's happening. On the left, you've got all the great headlines, the market's amazing momentum. But on the right, well, you've got these really serious economic headwinds. A conflict in a major shipping lane could easily send oil prices and inflation through the roof. And what's the Fed going to do about interest rates? It's anyone's guess. It's really a classic showdown between pure optimism and, well, reality.
To really get a handle on what might be happening today, we actually need to take a little trip back in time. Because what we're seeing right now, it looks eerily similar to one of the biggest market meltdowns in modern history, the dot-com bubble. And it seems like the playbook that led to that crash is making a major comeback. So here's a quick rundown of how it all went down. Back in the 90s, the internet was this incredible, revolutionary new thing, and investors were absolutely euphoric. They started pouring money into any and every tech stock, completely ignoring the basics, like whether the company actually made any money. The hype got so out of control that just slapping .com on the end of a company's name could make its stock price explode. But of course, gravity always wins. Reality hit, interest rates went up, and the whole thing came crashing down. And what's so wild about this is the sheer absurdity of it all. I mean, think about it. You had companies with absolutely no connection to the internet that were suddenly worth millions overnight just because they added a .com to their name. It was probably the clearest sign you could ever ask for that market hype had completely taken over from common sense. Okay, so let's fast forward to today. We're seeing the exact same story play out, just with a new star of the show: artificial intelligence. The technology is different for sure, but the way the market is behaving, it's almost identical. This is the modern-day version of the .com gimmick. I'm not kidding. Just this week, a shoe company, Allbirds, put out a press release saying it was pivoting to AI. One day, its market cap was about $21 million. The very next day after that announcement, it shot up to $148 million. They even changed their name to New Bird AI, a shoe company. And just look at this number. Over 600%. The stock gained over 600% in a single day. Let that sink in for a second. Nothing fundamentally changed about the company. No new product, no sudden profits, just the magic letters A and I added to their business plan. This is pure 100% speculation in action. So here's the bottom line. The playbook is identical. Back in the 90s, the magic word was .com. Today, it's AI. In both cases, a buzzword creates an insane amount of value out of thin air, totally disconnected from how the business is actually doing. It is a massive, flashing red flag that just shows you how powerful market psychology can be. But here's the kicker. That kind of market psychology is way more dangerous today because a major rule change has basically put it on steroids for the average investor. The environment we're in now is potentially even more treacherous, and it's all because of a huge shift in trading regulations. See, for the longest time, there was this rule that acted like a guardrail, protecting smaller investors from getting in over their heads. If you wanted to be what's called a pattern day trader, you had to have at least 25 grand in your account. That capital requirement was a barrier, right? It stopped a lot of people from making these rapid-fire, high-stakes trades with money they really couldn't afford to lose. But now, that safeguard is gone. So what even is a pattern day trader? Well, it's basically anyone who's making 4 or more of these round-trip trades, that's buying and then selling the same stock on the same day, all within a 5-day window. It's a really active, super high-risk strategy that used to be reserved for people who had a lot more capital to cushion any big losses. We really can't overstate the impact of this rule change. It rips away a crucial layer of protection and pretty much encourages a casino-like mentality. Now, when you mix the insane hype around things like AI stocks with the fact that anyone can now trade them in and out all day long, you've created a perfect storm for inexperienced investors. And yeah, it's fantastic for the brokerage firms who make money on every single trade, win or lose. But it puts the average person at risk of absolutely catastrophic losses, especially in a market as wild as this one.
Okay, so with all these warning signs flashing, how in the world do you protect yourself? This is so, so important, especially for those of you at or near retirement. This is the kind of market where disciplined investors can actually do really well, while the gamblers get wiped out. So let's talk strategy. Look, if you've spent decades of your life building your nest egg, now is not the time to start taking wild chances. Your hard-earned money is just way too precious. Right now, the single most important quality you can possibly have is discipline. It's time to play defense.
And when we say prepare for the worst, we're not just talking about the market going down. We're talking about a domino effect. Imagine this. The market drops, but because of global conflict, oil prices are high, so inflation keeps soaring. Companies, trying to stay afloat, start massive layoffs. Suddenly, you could find yourself out of a job in an economy where everything costs more, forcing you to sell your investments at the absolute worst possible time, locking in huge losses just to pay your bills. It's a small chance, but it's a possibility you have to prepare for.
So here it is, your simple, three-step financial shield. First, step 1, build your fortress. That means getting at least 6 months of living expenses saved up in cold hard cash. That's your buffer. Step 2, eliminate the drag. High-interest debt is like an anchor that will sink you in a downturn, so attack it, pay it off. And only after those first 2 steps are solid should you even think about step 3, investing with discipline.
So what does disciplined investing actually look like in practice? Well, Professor G, the source for this explainer, recommends a time-tested classic strategy, dollar cost averaging. It's simple. You invest a fixed amount of money into a broad market index fund, like an S&P 500 ETF, on a regular schedule. Rain or shine, market up or market down, you just keep investing. This whole approach takes the emotion out of it, helps you avoid the temptation to try and time the market, and it builds real long-term wealth. So when it's all said and done, it really just boils down to this one question. Are you an investor or are you a gambler? When you see a shoe company's stock jump 600% just because they said the word AI, do you feel that pull to chase it? Or do you stick to your plan? In a market this frothy, it's so easy to get the two confused, but knowing that difference and acting on it is what's going to protect your financial future.
Here's what's unsettling. Back then, people knew valuations didn't make sense. If you want to stay on the right side of that divide, subscribe, because in markets like this, discipline isn't optional, it's survival. And the next time you see a stock explode for no real reason, pause and ask yourself, am I investing, or am I chasing?